Did you know that a refundable credit is much more valuable than a non-refundable credit? In this video, I'm going to talk about the difference between a refundable credit and a non-refundable credit, and I'll give you some examples to illustrate the differences. If you're new to our channel, welcome. Please consider subscribing, sharing, or leaving a comment below. Doing so allows us to continue to make useful content like this. Let's first define what is a tax credit. A tax credit is a dollar-for-dollar reduction against your tax liability. A credit is much more valuable than a tax deduction because a tax deduction lowers your taxable income, but a credit actually goes against your taxable income. And I'll give you some examples to illustrate this. For example, let's assume that your taxable income is $100,000 and you're in the 30% tax bracket. If you get a $4,000 tax deduction, what happens is now your taxable income goes from $100,000 down to $96,000. So instead of paying tax on $100,000, 30% of $100,000, now you pay tax on 30% of $96,000. And as a result, that saves you about $1,200 because 30% of $100,000 comes out to $30,000, but 30% of $96,000 comes out to $28,800. However, if you receive a $4,000 tax credit, what that happens is that reduces your tax liability by $4,000. So let's go ahead and continue with the same example. You earn $100,000 of taxable income. You're in the 30% tax bracket. That comes out to $30,000. If you have a $4,000 credit, that gets deducted from the $30,000. So now you have a tax liability of $26,000. So if you compare the $26,000 of the tax credit versus a $28,800, you're much better off with a tax credit than a tax deduction. Now that we know what a tax credit is, let's talk about what a refundable tax credit is. A refundable tax credit gives you a refund even if your tax liability is zero, which is a great benefit because even if you don't owe any tax, you're entitled to a refund based on that tax credit. So for example, let's assume that you have a tax liability of $100 and you're also entitled to a refundable tax credit of $1,000. What that means is not only do you not have to pay the $100, but you get a tax refund of $900. That's because of that $1,000 refundable tax credit, $100 is used to offset your tax liability, and the remaining $900 gets given to you as a refund. Now that sounds really amazing, and that's the reason because why a taxable refund or refundable credit is much more valuable to you as a taxpayer than a non-refundable credit, which we'll go over next. But because the refundable tax credits are much more valuable to the taxpayer, there are not that many refundable credits available, and they're very restricted. So some examples of refundable tax credits are the earned income tax credit, the child tax credit. Both of these have very low income limitations, so that way a lot of people don't qualify for them. But if you do qualify, it not only eliminates your tax liability, it allows you to have a refund as well. Now let's talk about the more common non-refundable tax credit, which also reduces your tax liability dollar for dollar. But the big difference is that once your tax liability becomes zero, any unused credits you don't get as a refund. Let's use the same example I used earlier about the $100 tax liability. Let's assume you have a $100 tax liability and you're entitled to a tax credit of $1,000, but in this case, that $1,000 is non-refundable. What happens now is your $100 tax liability gets eliminated, but that $900 difference of the credit, you lose it. It doesn't carry over and you don't get it as a refund. Hence the reason why it's called a non-refundable tax credit.